Hello, chart guys. Viewers, want to introduce Matt, who is a moderator and a mentor in our chart guys community. This video, he is going over a look at some different indicators because we know everybody's looking at the market to top out on this bounce and to pull back potentially to test the recent lows. So he dives in here to look at some different indicators and some different ways to perhaps see some different clues as to what is the most likely scenario to play out from here.
Hey everyone, it's Matt here, and I just want to check in because a lot of people are looking at this on the S&P 500 and saying, wow, what an incredible bounce. And many people are now looking for the top of this bounce and waiting to see if we fall to a higher low and get a little bit of a tightening range on the weekly time frame, kind of looking like this. Or people are looking to see if we bottom out, we bounce, and fall straight to a lower low. But what I want to accomplish with this video is keep your mind open to the possibility that we can actually just recover and V-shape to an all-time high, or maybe we zigzag to an all-time high. But what I want to do is I want to look at a number of charts here, and my goal is to keep your mind open, if it's already open, to better than expected outcomes, or to open it to that possibility if you have a little bit of a bearish bias after such a significant 32% bounce. So even myself, I fully believe that the market has moved far ahead of the fundamentals of this market right now. I look at the news and I see the economy shut down across North America, across Europe, across the planet, and it boggles my mind that we can bounce like this in the stock market given that. And it's okay to have that bias, but I need to recognize it. And if you have that bias, you need to recognize it too. And you need to keep it in the context of the charts that are in front of you. And the charts that are in front of me right now, this is very, very bullish. This is a very strong daily uptrend. Dips are getting bought very quickly, and we're closing at the high of the day for 2 of the last 4 days and 3 of the last 7 days. So incredible bounce. Let's get into this. The first chart I want to look at here is diversified bonds versus intermediate US Treasury bonds on the weekly time frame. So we have a number of trend lines here. Let's go over each of them individually. The most obvious one here is our longer term resistance line at each of these bounces. We had a resistance line here coming down at a much sharper angle that when we broke out of, we saw some nice follow through. Little support line here along the way, and we've got this flattish support line here with numerous touches in this area. So one thing that stands out to me right away is I can draw a head and shoulders here, and when we broke that, we came down and we back tested that line as support before we fell. Another thing that stands out to me here is when we did initially break that head and shoulders bearish, we found support on this trend line here during the 2016-2017 consolidation before moving up to higher highs. But one thing that doesn't quite stand out on this chart, on the line chart, is if I move to candles, you can see this resistance line here, this sharp downtrend line that we broke out of. This came into play here on our recent dump, and you can see the significant bullish reaction to breaching that line. And this just bounced from, it was over a 7.5% move as a reaction to that line. And it's hard on this chart to see any historical, actually on this chart there's absolutely no precedent for a historical move like that. This move down and the bullish reaction to that. Now the reason the candles dip below that line but the line chart doesn't show that. The line chart is based on the close of the candle, so that's why you get some differentiation. When I examine these charts, I generally look at the line charts, but I do like to check out the candles as well, because sometimes you get these wicks, and the wicks won't necessarily print on the line chart. So this is the Diversified Bonds versus Intermediate US Treasury Bonds weekly chart. Let's now go and look at bonds versus stocks. So we have a look right here now where we have an RSI print above 70, and let's take a look at what we've seen in the past. So we have one other look where we have this major spike above 70 RSI on the weekly time frame, and that's back here. And what happened here is we topped out. And remember, this is the performance of bonds against stocks. This is that ratio. We topped out and we did retest the highs, but you can see we had this RSI trend line that was resistance from 2011 all the way to 2014 when we finally broke out of that. Breaking out of that didn't really see much more than just sideways action. We had a little spike here, but you can see each one of these little spikes just resulted in resistance. This one from last summer stood out to me because that's when we started to break above this trend line, and on the pullback it held this support and we had a bullish reaction to that. But again, this look here with this little double top looks pretty similar to me to this look here. This look here looks pretty similar to this look here. And this is the only other example we have of weekly RSI 70 breakout. So we're going to have to watch. Is this top going to just end up being a little spike? You can see that we are essentially encountering resistance right here. I'll draw a horizontal line. I'll fix the horizontal line. I'll change the color of it as well. There we are. And cooperate with me. You can see this is an area of resistance in the ratio of bonds to stocks. I'll move this guy here a little bit. We can see that better. Are we setting up what we've seen as a previous topping pattern right at resistance? Too early to say, but we're going to learn something every week as we learn more about the reaction to this 0.47 bond versus stock ratio. Next chart I want to look at is the ratio of SPY versus the 20-year Treasury bond ETF. So we have a few historical looks here on the RSI in a sub 30 breakdown. We have our most recent one here. We can compare that to this look here, and we can compare that to this look here. Each time we've seen this, what has happened? Well, we have this current look on the chart. We have a similar look here off of a similar trend line, and I probably should have started with the trend line, but connecting the resistance from 2008 to 2011, when we broke through that, we had a bullish reaction, and this line has been important in the stock market since May of 2008, before the financial crisis really came to light. This has been the line in the sand for bulls. January of 2015, it's been the line in the sand for bulls. February of 2016. Now, in March of 2020, it appears to be the line in the sand for the market bulls. This is a strong reaction from a very long-term trend line. You can see we had some shorter-term support lines here, grinding it, bought the dip off of it. We also had a slightly longer-term trend line, bought the dip off of it. When it finally gave way at the intersection of both of these lines, we had a strong bearish reaction. Now we're seeing potentially a strong bullish reaction with an RSI signal that in the past, on numerous occasions, has been a bottoming signal. Does that mean the bottom is in for this chart? Well, right now, the low of this does coincide with the low of this line. If you look here, the low of the RSI does not quite coincide with that sign, but we did not drop much further. The low of this RSI does not coincide with the low of this line. In fact, we fell another 22 weeks and about 40%. So keeping that in mind, even though our RSI signal looks similar to this, we can still see lower lows, and we have seen lower lows. But even though our RSI signal here is similar to this was effectively the bottom, and we saw stocks outperform the 20-year Treasury bond for almost 9 years and counting. The next chart I want to look at is the 10-year, 2-year yield curve. We have our inversion line, which recently acted as support. We have a downtrend line that we broke out of last year in May 2019. It was back tested in August 2019. And after holding, we had a little bit of a bullish reaction to that. We have a handful of similar historical looks. Let's get rid of that. This look here, this little spike, is similar to this look here. The RSI look just above 70 is very similar to this look here at 67, just below 70. You could even say I haven't highlighted it, but this look here is similar to this look here. What happened from here? We did go a little bit higher, but not much follow through. It started the long-term downtrend that has been in place since January of 2014. We've had little spikes along the way, some of them with similar RSI topping signals. Is this another little spike? It's hard to say, but as each week passes, we're going to learn more information about this. We can also see that we have a similar look to the present day back here in August 2007, both on the line chart, both in the RSI, and what we saw was a significant bullish move up from there. We even had a more extreme but similar RSI signal here. Still did not mark the top, kept going up. Keeping an eye on this chart to see what the reaction to this trend line is, and to see what the reaction to this signal is, because we've seen it in the past lead to much higher highs, and we've seen it in the past lead to much lower lows. The next thing I want to look at here is gold, the performance ratio of gold versus the S&P 500 on the monthly chart. So we had a downtrend line here and a breakout. You can see top, 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 top. Tops going back to February 2016 until we broke out August 2019 and back tested in November and held it. We have a look now right here that we have a few historical similarities too. One thing to mention, we bumped up against resistance here. Previous support back in April 2008, September 2008, November 2013, May 2014, becomes resistance in January 2015, February 2016, and potentially pulling back from resistance in March of 2020. This look here is similar to this look here, and this look here, and this look here. RSI signal, little bit weaker, but similar to this look here, this look here, this look here, this look here, and this look here. and this look here. And we have numerous ways this has played out in the past. Back in 2001, we did get a little bit higher. 2002, we grinded sideways for years until about 2005. Did get a little bit higher, grinded sideways for years. And this is when things started to go south in the market, when we put in a top in the summer of 2007. And we can see we had a bull move up. Gold started outperforming the S&P 500. We had that RSI signal again. A little bit of an equilibrium bull break with significant follow through. And we had a good pullback from there. But that gave the longer term monthly RSI room for another leg up. So this signal here will be interesting, especially with it occurring just below this long-term support becoming resistance line. We'll see each month new data on this chart, and we'll see if we do fade back and perhaps test this downtrend line again, or if bulls make their way back up to this 0.65 ratio, which is a key line in the sand on this longer term chart. The next thing I want to look at is the percentage of stocks above their 200-day moving average. And if we go back to the .com crash, let's just put our mouse here, and it looks like the low is at about 20. I'm just going to put a line at 20, and here we go. What is the reaction to having only 20% of stocks in the market above their 200-day simple moving average? In 2002, we saw a very bullish reaction, as when we had only 20% of stocks above that line, not long later we had 91% of stocks above their 200-day moving average. In 2008, we broke below it. We had a small reaction. We broke below it. We had a slightly larger reaction until we broke below it a final time. At the low, only 2% of stocks were above their 200-day moving average. What happened? We had very good things happen from there. Almost 95% of stocks a year later were above their 200-day moving average. Similar look in 2011, 2012, when we had less than 20% of stocks in the market above their 200-day moving average. What happened here going forward is we had a rally, 71% of stocks, and eventually 80% of stocks were then above their 200-day moving average. This is a similar look, a break below this 20% support. What happened here is the market rallied, 74% of stocks soon above their 200-day moving average. December 2018, once more a break below this 20% line. What happened here? We had a big push up and a little bit of volatility, but we ended up to a point with almost 68% of stocks above their 200-day moving average. So when we look at a chart like this and we look at the weekly time frame and we say, wow, what a bounce. You know, we can draw a, where is my tool? If we draw a Fibonacci retracement from the high to the low, we've already bounced over 50% of the way back to the all-time high from the low of the dump. We're approaching the 65% mark at the top of the golden ratio. I can't get in on this. This chart is so extended. When I look at this and I see that we had 5% of stocks above their 200-day moving average, and the last time we had that signal, we went from 5% up to 94%. Signals like this tell me we could be in for a very significant rally in the S&P 500, potentially into new all-time highs, and potentially much sooner than we think that can happen. We're still below the 20% ratio line here. We're at 19% of stocks are currently above their 200-day moving average. What's going to happen to the S&P 500 if we have that same reaction and have over 90% of stocks in the market above their 200-day moving average? In my opinion, the S&P 500 is going to hit all-time highs if we do get that same follow-through on that signal. So as impressive as this bounce is, and as extended as it looks right now, this is a look that tells me, based on historically similar signals, this rally could just be getting started. And if this extreme 5% reading plays out the same way, we could just be in the very early stages of a significant move. So we want to keep our mind open to all possibilities. Percentage of stocks above their 50-day. Let's choose 20% again, because that's what we looked at on the 200-day. And I'll draw a line here. What is the historical reaction to breaks below the 20% of stocks above their 50-day moving average? Generally, it's a very bullish reaction, with many more stocks soon above their 50-day average. This is a line in the sand that when only 20% of stocks or fewer are above their 50-day, generally more stocks soon follow suit and get well above their 50-day. We can see bounces around to 68%, bounces up to 80%, bounces as high as 92% of stocks soon above their 50-day moving average. This is a little bit choppier because it's a faster moving average. We're back above the key 20 part, but if you look at a bounce, and we're around here in January 2019, if you looked at the chart and said, wow, what a bounce, this is so extended, and I know I did look at that and I did think that, we saw significant follow through from that signal. So keeping an open mind based on this past series of the exact same signal we just got last month. And the last chart I want to look at is the percent of stocks above their 100-day moving average. Again, I'm going to put a line here right at 20 because that's what we've been using on our past charts. And you can see the reaction when we have fewer than 20% of stocks in the market above their 100-day moving average. And again, I'm looking at a weekly chart, but this is specifically the 100-day moving average. So don't get confused by that. We generally don't see that weakness for much longer in the market. 20% of stocks below their 100-day moving average is generally not sustainable based on historical signals. We had a nice move from 20 to 30, but ultimately to 68 and then 92, bouncing around 20, bouncing around 20. You can see here a break below 20 and a move to 61%. 2008, a break to 3.5%, and eventually, less than a year later, 92% of stocks were above their 100-week moving average. 2011, similar look, 8% of stocks were above their 100-day moving average. August 2011. 6 months later, over 85% of stocks are above that average. Right here, the chart probably looked extended, but we saw that the rally continued for months to come. One thing that stood out to me, this look here, we had about 2% of stocks above their 100-day moving average across the entire market. That's the same look we had here in 2008. And if we look at the S&P 500 from 2008, from the bottom, good things happened for a very, very, very long time in the market. So if that signal is similar to the signal we got at the bottom here, this is one hell of a buying opportunity right now. And even though we've bounced significantly and we look extended, we can use, as technical analysts, we can use our skills and our knowledge on the shorter term time frames to gauge the probability of continuation versus a reversal by watching the 4-hour trend or the daily trend or even the hourly trend if we're getting really into the details of it. But these looks tell me that we can continue for quite some time. So even though we will look at the headlines and see that we're potentially delaying openings and going to have sporting events with no spectators, and we're not sending children back to school until September, and that restaurants are only going to be able to operate at 20% capacity and have to remove 4/5 of their tables in order to support social distancing, these charts here are giving me a reason to consider better than expected outcomes, considering the month we just sat through on that dump and the month we just sat through on this bounce. We could very well be in the very, very early stages of a bounce. And again, going back to 2008, we probably looked very extended on the chart right about here. And, we are getting some of the same looks right now that we would have had right then. But good things happened on the internal charts, and good things happened on the stock market charts as well.